Thank you, Jeff, and a warm welcome from me as well. It's a pleasure to be launching the second iteration of the index. And this year we also have an interactive data bank, which is a new tool we've introduced where you can actually go online and play with the data and see how it all works. So there's a lot of information out there in the report. We couldn't put all the information in the report. So there is much more data available. You can go into every country, see how they've done on each pillar, see how they've done on every indicator, and compare also different countries. So I'll do a demonstration now to show you with an example how to play around with this tool. So if we can start the video, please. So you have the list of countries there on the left, and let's pick an example. So we can pick Ghana as an example. So once we click on the country, you see highlighted where it is on each of the different 6 pillars. So you can see that overall, while it's doing quite well, it's in the top 10, there is huge variation in terms of how it's doing. You can scroll over each pillar and see within the pillar how it's doing on the individual indicators. So market depth here, you can see that it has how it's doing on depth and diversity. And on another pillar that is not doing as well, again, you can see the variation within that. It's also interesting to compare one country to another. So we can see 2 countries that are similar to each other, and you have there the strengths and weaknesses of Ghana as well highlighted. So where it's done well, where it hasn't done well. And you see Ghana is very similar in position to, for example, Zambia. But then when you click on the country, you see that their makeup is actually quite different. So even though both of them are fairly close in the overall ranking, by using this tool, you can see where the differences are. And that's really the value of the index, because we all expected South Africa to come on top, but the interesting thing is what happens in this middle cluster and why countries that are in similar positions, one to the other, what are the priorities for them and where they can concentrate. So we hope you can use this tool and play around with it, because this is really the intention with this index, is to make it a practical tool for policymakers as well as investors in terms of, if I'm going to invest in this African economy, what are the things I need to be aware of? If I'm a policymaker, what are the areas which are most important in terms of focusing on progress? So I'll start with going through some of the different pillars. So I'll go through the first 3 pillars, and then I'll hand over to George to go through the rest. So Jeff has already given us an introduction of how countries did overall, and also an introduction to which are the pillars that we look at. So the first pillar that we looked at is market depth. So there we mentioned, and also in the introductory remarks, that countries need deep and liquid financial markets in order to create a domestic environment and also create opportunities for foreign investment. So in this pillar, we look at things like product diversity, what kind of products are available on the different stock exchanges. Some countries don't even have stock exchanges. Ethiopia, for example, only has a commodities exchange. In the case of some exchanges, there's no securities traded in the Angolan stock market, for example. And some stock exchanges don't have corporate bonds traded in them as well. We also look at the depth and liquidity of the market, so things like equities listed, bond turnover, and market capitalization to GDP. And there, African economies as a whole fare below the global average in terms of market capitalization to GDPs, around 56%. But this figure also masks very huge divergences across the continent. So there's only 3 countries that have market capitalization as a share of GDP over 100%, and these are South Africa, Ghana, and Botswana. And then we have quite a few countries that have very low market capitalization to GDP, a few even something like 5%. So there's very huge differences in the countries that we look at. And then in terms of the size of the corporate bond market, that's also very low. And that means that a lot of the exchanges have a lack of market makers. So you have investors that tend to be buy and hold investors. So they buy bonds, they hold them to maturity, so there is not much of a market. And these are the things that we look at in Pillar 1. So looking at how countries have done over the past year in this pillar, because now that it's the second edition, we also have the opportunity to see what policies were implemented, which were the countries that saw their scores increase the most and decrease the most. And here we have some highlights of that in terms of Ghana, Kenya, and South Africa increasing their scores considerably. In the case of West Africa, we've had a few of the exchanges working closely together to harmonize their standards and also lower the barriers for new investors to enter the exchanges. So having, for example, some exchanges where smaller and medium enterprises can enter in a form of incubator to make sure that they can then list on the larger and main exchanges. So this has been an important development. There's also the creation of new products which attracts investors. So for example, in the case of Ghana, the real estate investment trusts that were introduced, and also in terms of how the exchanges are used. So Nigeria introducing an online trading platform, for example. On the negative side, and these are not policies that were necessarily intended in that way, but sometimes it highlights the importance of keeping a balance between introducing a regulation that we think that will boost capital markets, but maybe sometimes it's too soon. So, for example, in Tanzania and Namibia, there were measures to boost local investors or to make investors hold local and local securities. But that there was not enough local investor base to take up this. So that meant that it had a negative effect overall. So moving to Pillar 2, this is access to foreign exchange. So because Africa's capital markets tend to be quite small and underdeveloped, it's very important to rely on foreign investment. So this pillar looks at the conditions and the infrastructure for foreign investors to be able to deploy and repatriate capital from African financial markets. And in terms of the final results for this year, it's one of the pillars where actually South Africa did not top the list, unlike the other 4 pillars in which it did. So last year, as was mentioned earlier, we had South Africa topping the list for all 6 pillars. This year, in the case of access to foreign exchange, Kenya earns the top marks. And that's because of relaxation of capital controls and also an improvement in terms of its portfolio flows to reserves ratio. Overall, in the survey that we ran in access to foreign exchange, a lot of survey participants which came from international organizations, the investment community, and also accountancy firms and domestic participants highlighted that in the long term, it's important to have open capital markets. In the short term, that creates vulnerabilities, however, and central banks and other policymakers need to adjust for that and prepare for that. And we saw this summer how vulnerable emerging markets can be with the latest Fed policies that created vulnerabilities for emerging markets, including South Africa. So South Africa has one of the most open and liquid foreign exchange turnover markets in the world amongst emerging markets. However, that makes it vulnerable as well to sudden capital outflows, as we saw this summer. So it's important to strike that balance between openness, but at the same time also being prepared in terms of having high levels of foreign exchange reserves. But overall, the trend that we saw this year is that a lot of markets, the financial markets that we track, are moving towards greater openness. So I'll highlight some of the results here. For example, some countries are relaxing their capital controls or moving towards more flexible exchange rates. There is also single exchange rate. So this pillar also looks at the level of exchange rate reporting. Are there multiple exchange rates that investors can get confused by, or do they move towards a single one? So this is where we saw a lot of progress this year. But of course, there is also the fragility that comes with the openness, and some countries are especially vulnerable to that. In the case of Mauritius, for example, or South Africa that I mentioned earlier, which has a very high foreign exchange turnover. Moving to Pillar 3, this looks at market transparency, tax, and the regulatory environment. So this is about the infrastructure underpinning financial markets. So again, this is about having a strong regulatory environment, but also striking a balance with flexibility and making sure that this regulatory environment is set up in a gradual way so that investors can also adjust and be aware of the changes that are made, because we've seen in some cases that changes can be too fast, and this needs to be managed in a gradual way. So it was mentioned earlier also in the keynote in terms of the continental free trade area, the harmonization of regulations in terms of the movement of capital across the continent. This is all very important. It's also about preventing fragmentation. So in the case of South Africa, for example, where 4 new domestic exchanges have been introduced since 2016, how do we harmonize harmonized regulations there. And it's also about adherence to standards, such as, for example, the Basel regulation for banking. So last year, only 7 countries were signed up in Basel III out of the 17 economies that we had last year. This has now increased to 12. So economies are making progress there, but there's still some countries that are very much behind. So Ethiopia, for example, are still in Basel I phase. So there is progress there, but important regulations such as Basel, it's important for them to continue to grow and move towards Basel II and eventually Basel III as well. There's also the issue of high capital markets transactions in some cases. So we've mentioned there the case of Uganda, which is also negative. And also in terms of the IFRS standards, where some countries are moving their status from permitted but not required to required. So there is progress there in terms of moving towards the signing up to these regulations like IFRS, Basel, and so on, and in the case of tax as well and reporting. And this is something that was very clearly highlighted in the survey as well from, as I mentioned, international organizations, foreign investors, domestic accountancy firms, that there is this regulation that is being implemented more and more, but it's also about harmonization across the continent and making sure that different countries are moving in the same way. So I'll hand over to George now to go through the rest of the pillars, and hopefully we can continue the conversation later.